Well, it's time to discuss bonds, stodgy bonds, boring bonds, reliable bonds. Do you want to eat well or do you want to sleep well? With bonds, we can sleep well. In fact, none other than Andrew Carnegie, you've heard of Carnegie Hall, said, "Gentlemen prefer bonds." And he said this before the movie Gentlemen Prefer Blondes. So he one upped them, not the other way around. Yeah, it's something we need to discuss. A very important choice for many people, but not real exciting. Oh well, let's get started. Slide number 2. What are bonds? Well, they're loans. They're securities. Bonds are negotiable, publicly traded, long term debt securities. They're loans, basically. Think of them like a mortgage. Whereas the issuer agrees to pay a fixed amount of interest over a specified period of time and to repay a fixed amount of principal at maturity. So they're sometimes called fixed income securities or fixed income investments or just fixed. You'll just people say, "Oh yeah, I'm in fixed investments." Debt financing, they're a way for a company or a municipality or the federal government to finance their operations. They're really just an IOU. And you get to play the part of the bank. You get to lend your money to corporations, corporate bonds, or state and local governments, municipalities, municipal bonds, or the federal government, treasury bonds. And then they're going to pay you interest and they promise to pay you the principal. Now, do most people pay their mortgages, their car loans, their credit card? During normal times, yes. And even during tough times, still, most people pay. A lot of people go into bankruptcy, and that sometimes happens with bonds. So if you buy bonds, unlike stocks where you're an owner, you're part owner of the corporation, of the enterprise, in bonds, you are a loaner. You are lending your money to someone else. Now, these are very large corporations, municipalities, federal government. So these are huge entities, and we normally get paid our money back. And that's why bonds allow us to sleep well at night. Slide number 3. When you borrow money for a house, you're going to fill out a mortgage document. And it is dozens and dozens and dozens of pages these days. Well, the same thing is true when a bond is created. There is a document called the trust indenture. It's a contract that sets forth the terms between the issuer and the bond holders, the bond investors. It describes the bondholder's rights and the issuer's obligations, and a trustee is appointed, somebody to oversee that these obligations are carried out. Now, there are trust companies and commercial banks that this is their job. They watch over the corporations, the municipalities. Well, nobody really watches over the federal government. That's well, we won't go there. We're citizens. We, the citizens, are supposed to be watching over our elected representatives. And the trust indenture stipulates the protective covenants. Those are the obligations of the bond issuer to keep doing business, to keep the equipment in good working order, to make the payments on time. And a good example of the protective covenants is Southwestern Community College. You've seen, if you've been on campus late of the last few years, they're destroying they're revitalizing the campus. They're tearing down these beautiful old buildings and putting up these horrible boxes. And we've just got yet another onion. Every year there's an architectural group that hands out orchids, which are beautiful buildings, rewards, and then onion rewards, which are horrible, ugly, no good, very bad buildings. And we've gotten a few in the last few years. Ugh, that math science building looks like a prison with those bars on it. And now we got just another one just recently for the the building that just I forget what they're doing over there. I think they're making Play-Doh or something like. No, it's the performing arts. Anyway, yes. I'm sorry. Anyway, I digress. When we asked the voters of the South Bay, "Hey, we're Southwestern Community College. Will you allow us to put?" Well, we put a bond issue on the ballot. Will you allow us? Will you vote yes and allow us to issue bonds, make a big loan, millions, hundreds of millions of dollars? Oh, by the way, you have to pay for that over the next 30 years through your property taxes. And the voters said yes. So now the protective covenant said you have to, Southwestern Community College, we have to use that money to build those buildings. We can't give ourselves a raise or throw a big party or anything like that. And so there's a trustee that watches over and makes sure that we do that. Anyway, why invest? There's a whole lot of kinky panky that went on over the years, dear students. I apologize on behalf of my college. I love teaching there, but when it comes to administration, oh boy. Anyway, slide number 4. Why invest in bonds? Well, bondholders receive the interest. That's over the long term. That's what you get from your bonds is your interest. And normally in the United States, interest is paid every 6 months. We'll talk about annual interest, but it's really, we get it every 6 months. Some bonds pay quarterly, some bonds pay monthly, but no, most bonds all pay every 6 months. And at the end of the maturity, 2, 5, 10, 20, 30 years or more, you get your money back. However, there is also a potential for a capital gain or a capital loss. Wait a minute. How could the value of a loan change so that you could gain money or lose money? Ooh, we're going to spend a lot of time on this. If interest rates fall, there is a potential for a capital gain, but there's also a potential for a capital loss if interest rates rise. And we'll discuss this later. It's the trickiest part about bonds. But if you intend to hold the bond to maturity when you're paid back your loan, you don't care. You don't care about capital gains or losses. They don't affect you. It's only if you have to sell your bond before it matures that this is a problem or a benefit. Some bonds have tax advantages, as we'll see with municipal bonds specifically, but treasuries have a little bit of a tax advantage. And some bonds can be converted into stocks. What? Convertible bonds? Convertibles? Sounds sexy, doesn't it? Convertible driving down the road with your hair going through the wind or wind going through your hair or something like that. No, they're not. And we'll discuss those in a later time when we get to hybrid securities. So, also, slide 5. Bondholders are first in line for repayment if there's a default on the loan. So bondholders are at the front of the line. Well, actually, taxes, if there are any, they're usually not if the company's going through bankruptcy. And then payroll. You got to pay the employees. Who's at the back of the line? Right, the stockholders. That's why the stockholders usually, when a company goes bankrupt, get nothing. The bondholders get to pick the carcass first, and they usually walk away with something, but the stockholders usually get nothing. So another reason why bonds allow us to sleep better at night, even in the rare case of a bankruptcy, we're at the head of the line. Bond prices are far less volatile than stocks, but they still fluctuate. Bond prices can go up and down, and they do go up and down, especially they go down when interest rates rise. And the average return over decades, it depends on which decades you look at, but we're going to say 2 to 6%, 2 to 4% for municipals and treasury bonds, 3 to 6% for corporate bonds. But it used to be higher, just like mortgages used to be higher. People, you talk to your parents, your grandparents, and they'll tell you they had a mortgage for 12% or 10%. Well, not anymore. Bonds are not paying anywhere near that. They used to pay 7, 8%. We could readily find bonds that paid that, but not anymore. Currently, as we just said, many bonds are paying far less than their historical returns. Only a few are paying more. Now, which ones do you think are right? The ones that are more risky. You figured this out, right? More return, you're going to accept more risk, right? And we'll see as we go along. Okay, now, we've just spent a whole lot of time on stocks. So let's take a look at bonds versus stocks. And we've seen that over the long term, meaning 10, 20, 30, or more years, stocks have outperformed bonds. So why would you invest in bonds? Well, stocks are far more volatile. They carry more risk. Bonds offer an element of stability to your portfolio. Some people use the term ballast. If you can, if you're in the Navy, if you've been in the Navy or you're a sailor, you know what ballast is. It helps the ship from turning over. And for some investors, stocks are just simply too risky. They reason, if I can obtain my long-term goals without taking on the risk of being invested in stocks, well, so be it. It's the I can sleep better at night factor. Well, I'm going to tell you something that I'm not supposed to tell you. I can get in trouble for saying it. Stocks must outperform bonds over the long term. And we mean long term, 20, 30, 40 years. There have been in the past significant periods where bonds have outperformed stocks. The 2000s were a perfect example. They were called the 2000s, from 2001 to 2009, or 2000 to 2009, 2001, 2010, were often called the lost decade because stocks returned negative 0.95, about negative 1% over the 10 years. You have to go back to the Great Depression to see 10-year periods where they were negative. But why, Payano? Why are you saying that stocks must outperform bonds? Well, it has to do with our structure of our capitalist society, our capitalist economic system. How are bonds paid? Well, from a corporate standpoint, they're paid from earnings, right? You got to earn the money to pay the interest and pay back the principal. So let's say the economy has tanked. I mean, seriously tanked. The stock market just hasn't crashed. It has evaporated because there's no food at the no food at the grocery store, no gas at the gas station. There's no clothes to be found. The cell phones aren't working. The trash isn't being picked up. The sewers are backed up. There's no water, and the hospitals and the schools and the banks and the fire departments and the police departments are all shuttered. Well, what's going to happen? The bonds aren't going to be paid. They're going to fall apart, right? They're going to eventually fail. It doesn't even have to get that bad for corporations to not be able to pay their bond payments. And the same thing is true for municipal bonds and treasury bonds. Municipalities and the United States Treasury pay their bonds back through taxes. If individuals are not earning money to pay their taxes, they don't have to pay any taxes because they're not earning money. So eventually the bonds will fail. Failure is not an option. We must put on our clothes, our pants, our dresses, or our suits, whatever, get out there and earn and make. I know it sounds like an advertisement from the 1950s, but it's the truth. It's the truth. We must not allow this economic system to fail. And so if it doesn't fail, stocks over the long term will do better than bonds. But there are times when stocks are pretty darn expensive and bonds are just screaming good deals. I don't think at this point in time, what is this, late 2021 or so, that either are screaming good deals, but there are still good stock deals, and there are some bonds out there that are okay, but I'm not a big bond fan, so you're getting it from not from the person who's a big bond fan. I'm not James Bond or Barry Bonds. And also, bonds also make good intermediate term investments. Whereas stocks, right, we need to think 4, 5, 6, 7, 10, 20 years. Whereas bonds, we could hold them for a few years and be relatively assured of not losing a whole lot. Because even when bonds go down, they don't go down anywhere near as much as stocks, as we shall see. Okay, let's take a look at the risks. So we always have to keep in mind the risks of investing. Bonds have risks, nowhere near as much as stocks, but they do. And Interest rate risk is the one we've been discussing obliquely. We'll get to it soon enough. Hang on a minute. When rates fall, bond prices rise. When interest rates fall, bond prices rise. When interest rates rise, bond prices fall. Think of a seesaw, and we'll have a graphic in a few slides, so just relax. If you intend to sell the bonds in the future, you could have a capital loss if interest rates have risen. You could also have a capital gain if interest rates have fallen. If you have no intention of selling your bond, you're going to collect the interest and then get paid your principal back. That doesn't affect you. Purchasing power risk. Inflation is a bondholder's worst nightmare. This is the risk that your purchasing power will fall if inflation outstrips your return from bonds. So why? Because you're being paid back in dollars that have less purchasing power. So that's an issue that we have to think about when we invest in bonds. We also have to worry about business risk, financial risk. The two are basically the same. The business can't make the payments. This is a problem more with corporates, although there's sometimes municipalities that have gone belly up. But even when they do, the bondholders usually get bailed out. I don't care what anybody says, the United States Treasury is not going bankrupt. It's not going to happen. There's political posturing that goes on from time to time, but no, the United States is not going bankrupt. Right? You should. I mean, yeah. Enough said. Okay, slide number 8. We have a definite problem, folks, but we'll deal with it. We're very innovative and resourceful and resilient. Slide number 8, liquidity risk. This can be a problem with bonds because bonds tend to be thinly traded. What does that mean? People hold on to their bonds. They buy their bonds and then they hold on to them for the interest, and they don't sell them. They don't, and so that can be a problem. It's less of a problem with treasuries and munis, and certainly with high quality companies, large companies. Somebody's going to buy your bond, but it can be a problem with thinly traded bonds. And then there's the call risk. It's also referred to as the prepayment risk. This is the risk that the bond will be called away from you before its scheduled maturity date. Huh? Well, think about it, folks. If you have a home loan from 10, 12 years ago, you really need to go down to your credit union, your bank, and take a look at what they're offering now, because interest rates have fallen and you can refinance. Well, that's what a calling the bond away is. The bond issuer, the corporation, the municipality, the Treasury has never called away bonds. Will say, we want to refinance. We call that calling the bonds away. And so you get your money back, but now you got to go find a new bond to invest in. And as we said, some bonds are non-callable, such as Treasuries. We'll discuss this in detail in a few slides. So let's talk about interest, because over the long sweep of time, that's what we get from our bonds, the interest payments. It's actually called the coupon rate. What a silly name. Coupons? What are you talking about here? Or nominal rate, coupon yield, nominal yield, rate and yield are basically the same. This is the interest amount that is going to be paid on the bond. The interest, as we said, is usually paid every 6 months, although there's a few bonds that pay every month, quarterly, once a year. Now, where did this coupon rate come from? It comes from the fact that bonds, not anymore, but used to have coupons attached to them. Literally, when the interest was due, an investor was required to clip the coupon, cut out the coupon or pull it apart and send it into the bond issuer. And the bond issuer would then send the bondholder the interest. They'd send them a check. To this day, earning interest from a bond is often called clipping the coupon. You're going to hear this, folks. You're going to hear clipping. I'm clipping the coupon on this great bond, even though virtually all transactions now are done electronically. Now, why did they do this? Well, it actually made a whole lot of sense before electronics and telecommunications and the like. Why? Because you could easily just sell your bond to somebody else. And now all they had to do, they paid you the money for the bond, you gave them the document with all the coupons attached to it, and all they had to do was clip the coupon, put their name on it, and they would get the interest payments. You see, it made sense a long time ago, not anymore. But you're still going to hear coupon rate. You're going to see it written. So you have to know it. That's the rate of the bond, the yield of the bond. It's also called nominal yield. So learn those. Slide number 10, the principal. That's the amount of the loan, the amount of capital that must be paid at maturity. So it's also called par value and face value. So those three words you have to equate with one another. The par value, the face value. And in our class, we will always use $1,000 increments. Most bonds are denominated in $1,000 increments. Now, there are some that are 5,000 and 10,000, but you know what? Just forget it. For this class, all bonds will have a principal of 1,000. So, putting the coupon rate and the principal together tells you how much interest you will receive each year. For example, if the coupon rate were 7%, the principal is 1,000. It will always be 1,000 in our class. That gives you $70 of interest. It makes it very simple. If it's a 5%, $50. If it's a 3%, $30. If it's a 10%, $100. If it's a 1%, $10. So you see how easy that part is? That's one of the easier parts of bonds. If I know that it's a 7% bond, I'm going to get $70 of interest. Now, I actually get $35 twice, $35 6 months and then $35 the next 6 months. And since almost all bonds are denominated in $1,000 increments, knowing the coupon rate gives you the amount of interest. Therefore, normally bond investors simply refer to their bonds by the coupon rate and the maturity. I bought a 7% 30-year bond. So the person he told that to, or she told that to, knows that they're going to get $70, $35 twice a year for the next 30 years, and then they get their $1,000 back. That's how it works. The maturity date is the date on which the bond matures and the principal must be repaid. Now, when we think of a loan, we usually think of it as you pay some interest, you pay some principal every month. That's not the way most bonds work. Most bonds are term bonds. They mature all at once. So they're the most common. For example, a company will issue 20-year bonds that mature in 20 years all on the same date. Now, they'll often create some kind of sinking fund to build up the principal to pay it off. They don't just wait until 20 years and then go, uh-oh, what are we going to do? I guess we go make some more loans. But the companies know that the debt is coming due, so they handle it accordingly. There are some bonds, they're not the most frequent, they're more rare. They're called serial bonds, and they have a series of maturity dates. So, for example, a company may issue a series of 20-year serial bonds with 20 maturity dates, each maturing every year or every 5 years for 20 years. So a certain portion of the issue would come due and be paid off. The series matures. So you understand? That is, the serial bonds are more what we think of when we think of a loan. We pay some principal, we pay some interest. But that's not the way most bonds work. Most bonds are term bonds, and they mature all at once. Now, I don't like this, but it's one of the curveballs that they throw at us when, there's all these weird things about bonds that just drive you person nuts. Notes. Technically, there's a difference between a bond and a note. Now, the only difference I'm aware of is that notes mature in 2 to 10 years, whereas bonds mature in 10 or more years, usually 20 or 30 years, and sometimes even longer, 50, 100 years. There's a very small number of bonds that never mature. They're called perpetuities, which is a wonderful word to use with your friends. You get to spit on them. Perpetuities, consols. In practice, most investors, including yours, truly use the term bond to refer to both bonds and notes. So if you're talking about the 2-year or the 5-year treasury bond, somebody is going to say, oh, no, it's the 2-year treasury note. And you can say, yeah, sure, buddy. Yeah, so just know that, okay? But don't worry about it. I certainly don't. And so far, I'm still holding down the job. Slide number 13. Here's the call provision. Here's the the ability of the bond issuer. Now, the bond investor really doesn't have much control over this. It's the bond issuer. The call provision allows, it's the provision that specifies whether and under what circumstances the issuer can retire or prepay. You can think of it like as we said, like prepaying your mortgage or refinancing your mortgage or prepaying your car loan. If interest rates drop, just as a homeowner would want to refinance their mortgage, a bond issuer would want to refinance their bond loans. So they call in the bonds. Come here, bonds, come here. The bonds are called away from the bond investor. The bond investor gets their money back, they get their principal, but what's happened? Interest rates have fallen. So now if they take that money, they're going to find that they're going to get lower interest rate because they have to reinvest that with new bonds. All other factors being equal, and they never are, investors would prefer non-callable bonds to callable bonds. So, what are some of the provisions? Well, some are freely callable. They can be recalled at any time. They can be retired, redeemed at any time. We send you the money, you got to give me back the bond. Non-callable is the most restrictive. That means they can't call them. They would love to, but sorry, you signed the trust agreement, which said that these bonds are non-callable. So you, Mr. or Ms. Bond Issuer, the corporation, the municipality, in the case of the Treasury, you have to wait until that bond matures before you can pay me off and stop paying me my interest. And then what's typical is a deferred call period, a call protection period, a call deferment period. The issuer must wait a certain length of time to pass before the bonds can be called away. So, most corporate municipal bonds are freely callable or they have a deferred call. Deferred calls are very common, especially with muni bonds. Treasuries, so far, the United States Treasury has never issued callable bonds. They are always so far non-callable, which is the least desirable, certainly freely callable, and most desirable is non-callable, and deferred call is somewhere in between. So that's something we have to think about when we purchase our bonds, and it actually affects the possible return we'll get for bonds, and we'll play with those calculations in the next chapter. Okay, along with the call provision is the call premium. This is the amount that is added to a bond's par value and paid to investors when a bond is retired prematurely. So what does that mean? You know what? You're going to call my bond away, but there's a prepayment penalty at $85 or $50 or $30 premium that you have to pay on top of the principal to call it away from me. You might, most mortgages don't have this anymore, but some do. If you want to refinance the home mortgage, you're going to have to pay a penalty. It's not common, but it happens, but it happens in the bond world. You'll see. We'll take a look at some examples that have a premium. So then the call price or the redemption price is the price the issuer must pay to retire a bond prematurely. It's equal to the par value plus the call premium. So $1,000 par, remember, all the bonds in our class will always be $1,000. And then let's say there's an $85 call premium. That means to call the bond away from me, Mr. or Ms. Bond Issuer, corporation, municipality, you have to pay me $1,085. And if there's no call premium, the bond is said to be callable at par. So that's what you'll hear. You'll hear, oh, these are callable at par, which means, if they want to call them away from you, they only going to give you $1,000 back. There's no prepayment penalty. So now, finally, slide 16. And get your thinking toque on, because this is the part of bonds that drives people the battiest. Professionals who've been in the industry for years get tripped up. So don't feel badly if you don't feel bad if you trip up, because everybody does. By far, the most misunderstood feature about bonds is their inverse relationship with interest rates. When interest rates fall, bond prices rise. When interest rates rise, bond prices fall. if you think of the seesaw, keep the image of the seesaw in front and center, and it will make a whole lot more sense. Remember when you played on this? Maybe you still do. I love the seesaw because if you jumped on top of it, you were up here, and then all you had to do was that no, you're down here, right? You're down here. See, it gets confusing, and you jump off, and then the guy or the gal at the top goes boom. Yeah, I wasn't a bad kid. I'm still a kid. Anyway, so think of the seesaw. Interest rates fall, bond prices rise. Interest rates rise, bond prices fall. That'll help a lot. I think. So, a bond could either be selling at a premium. That's a bond with a market value greater than the par value. What's happened? Interest rates have fallen, so the bond price has risen. So now it's selling at a premium. It's selling at higher than the par value, than the $1,000. Or you could have a discount bond. This is a bond with a market value lower than the par value. This occurs when prevailing interest rates are greater than the coupon rate. So interest rates have risen, your bond price has fallen. In either case, you don't have to sell your bond. You can just hang on to it, and eventually you get your $1,000 back. But if you were to try to sell it now, yeah, if it was a premium bond, you'd make a capital gain. Hooray. If it were a discount bond, oh well, you're going to have a loss. There's also a situation where you can have a discount bond when and if the investment community believes that the bond issuer is in danger of defaulting on interest payments or principal payments. And we'll see that with Ford and then Poway School District. There's a presentation I want you to see. It shows that. We, of course, do it in the face-to-face class. So check out that presentation and see what happened in the Great Recession, the global financial crisis, to the Ford bonds and the Poway School District bonds. If there is no premium or there is no discount, the bond is said to be selling at par, selling at 1,000. And yeah, some bonds are 5 and 10,000, but just remember in this class, everything's $1,000. So, now you're probably scratching your head, and I don't blame you. Wait a minute. Why would a bond sell at a premium or a discount to its par value? If the loan is for $1,000, the bond would always sell for $1,000, right? No, that's not how it works. Curveball. Since the interest rate on your bond doesn't change, it is fixed. That's what we call bonds fixed, right? They're fixed interest, fixed investments. The price changes of the bond. The price of the bond changes to reflect the change in the prevailing interest rates within the financial industry. So remember the seesaw? Interest rates have risen, our bond's going to fall. Interest rates have fallen, our bond's going to rise. How does it work? Well, let's take a look. Slide 19. You have a bond paying 10%. Now, this was 1985 or something, 1987. Okay. And bond's face value is $1,000. What happens? Every year you get $100. Actually, you get $50 twice a year, but let's just say you get $100 every year. Now, interest rates fall to 8%. Oops. New investors have to pay more money to get that same amount of interest. They'd have to pay $1,250 to get $100. Because if they pay $1,000 on new bonds, they're only going to get $80. So the result is your bond is now worth more than it was. You're not going to sell your $1,000 bond paying $100 when new bonds are only paying $80. You're going to demand a premium. And depending on when your bond matures, you might get a very high premium because, 2 full percentage points. You'll hear 200 basis points. Because a basis point is 0.01. I don't know why they do that. Why don't they just say 0.01? They say basis point. Another curveball in the bond world. A 2% drop, that's a pretty big drop. So your bond would now be worth a lot more. Now, you might think, it's going to be worth $1,250. No, it doesn't work that way. It depends on the maturity of the bond, as we'll see later on. But just for now, no, it's going to be worth more. And the same thing happens in reverse. Slide number 20. You have a bond paying 10%. The bond's face value is $1,000. Again, you're getting 10% of $1,000 or $100 every year, $50 twice a year. And now interest rates rise to 12%. New bonds for $1,000 are paying $120. Investors need only pay $833.33 to get that same amount of interest. So now nobody's going to pay you $1,000 for your bond only paying $100 when new bonds are paying $120. If you wanted to sell, and you don't have to sell, you can hang on to your bond, you're going to get your $1,000 back. If you wanted to sell, though, you would have to offer your bond at a discount. You would have a capital loss. So you see how bond prices change? They change inversely to the movement of interest rates. So I know it's a little tricky, but it's how it works. And on slide 21, we see that the amount of the premium or discount is not only related to the amount or the fall or amount of the fall or rise of the interest rates. In general, the greater the fall or rise in interest rates, the greater the premium or discount. So it's not only the amount of the rise, the fall, the rise of the interest rates, it's also how long until that bond matures. And when you think about it, when you think of that seesaw, it makes sense. In general, the longer the maturity, the greater the premium or discount. Remember when you played on the seesaw? Remember I used to do this. I used to love to get in the middle because then you can go back and forth, but you don't really move a whole lot. You move a little bit back and forth. If you're out 30 years, if you're out the way at the end of the seesaw, then you go way up and you go way down. So that is why, if you remember, we were just talking about mutual funds. Long-term bond funds have greater risk. They have greater volatility than short-term bond funds, and intermediate term or somewhere in between. So the closer and closer you get to the maturity date, till the bond matures, it starts to look like a money market. It starts to look like a treasury bill or a corporate paper. Yeah. And so that's why we couldn't just assign a number. We couldn't say, well, yeah, that bond is going to be worth $1,250 or $833. No, it's more subtle than that. We have to know when the bond matures. And we'll learn the calculations in the next chapter. So here's a graph that kind of shows you what happens. Now, remember, it changes, it has to do with the marketplace. But let's say you have a 30-year bond and interest rates fall. Well, your bond, is going to go way up in the air, right? And if you have a 30-year bond and interest rates rise, your bond is going to fall precipitously. But as you get closer and closer and closer, either way, interest rates have fallen or interest rates have risen. You get closer and closer to the maturity level, the bond is going to get closer and closer to the par value. So what we did is we used percentage. We maybe should have used numbers like $1,000 and $1,100, but we use percentages. So same idea. Don't worry about the price. It's just the idea. The farther out you are on the seesaw, the more your price is going to fall if interest rates rise, or rise if interest rates fall. It's tricky, but just go back over it a few times and it'll start to make sense. In general, long-term bonds exhibit greater price volatility, but a greater opportunity for capital gain or loss. Intermediate term and short-term bonds exhibit lesser price volatility and a lesser opportunity for capital gain or loss. Bonds very close to maturity act very similarly, I guess it should be very similarly, to short-term investments such as money markets, treasury bills, corporate paper. However, we're going to reiterate, if you intend to keep the bond until they mature, keep your bonds until they mature, you don't care about the price volatility. You will always receive your interest payments and your par value of the bond, except in the rare case of a bond default, and then that's a whole other world. You get in line with the other bondholders and they say, we're going to pay you 80 cents. We're going to pay you $800 or we'll pay you $900, but you get something. What do the stockholders get? Nothing. Slide 24. This is a review. Do you remember this slide from our introduction to stocks? This shows the relationship of the yield on bonds, what we get from interest payments on our bonds, and dividend payments on our stocks. And we go way back to 1960, and we see they're pretty darn close to one another. But then as inflation started to take hold in the late 70s and 80s, what happened? Bond investors demanded higher and higher interest payments because the inflation is a bondholder's worst nightmare. And then we told you the story about Paul Volcker, the Federal Reserve chairperson, who said, well, Mr. Carter, yes, Jimmy Carter, we had a president by the name of Jimmy Carter, and we're going to break the back of inflation. It's going to make a bad recession. You might lose the presidency. And to Mr. Carter's credit, he said, go right ahead and do that. And they did. They broke the back of inflation. And sure enough, we see interest rates falling and falling and falling. And oh, what a great time to own bonds. Oh, what? Interest rates fall, bond prices rise. Bond investors just had a 30-year, 1980s, 1990s, and in 2000s of falling and falling interest rates. And now they're at generational lows. Can they go any lower? I guess so, but I don't know how much lower they can go. And we saw that the yield on stocks popped in the 1970s as the price of stocks plummeted. But we saw the yield on stocks, the dividend yield, as why? Investors were, I don't want dividends. Like, give me capital gains. And so the dividend yield kept falling and falling until it hit 1% in 2000, March 2000, which was the height of the internet bubble. And since then, dividends have sort of risen and bond rates have gone down. And then in the Great Recession, the global financial crisis, dividend yields went above the bond yield. That was a great time to buy stocks, and it's happened a few times. Right now, they're both very low. It's gone back up. The 10-year is up to like 1.8 or something like that, 1.7 or so. But it was down to 1.3 or 4, 1.4. And the same thing was true of dividend yields. Dividend yields had fallen very far. There's still some companies paying decent dividends, but it's everything's really expensive, folks. Interest rates fall, bond prices rise. So bond prices are expensive. Stock prices are expensive. Real estate is expensive. And so is crypto and NFTs and meme stocks. I don't know when, but it's going to happen. We're going to have a crash. And is that something you should be worried about? No, you should be licking your chops and rubbing your hands and saying, I can't wait. Do you want to eat well or do you want to sleep well? Well, folks, we hope you're going to eat reasonably well over the long term and sleep reasonably well over the long term. I think so. Unless the world ends, in which case it doesn't matter where your money is. Yeah. Okay, so now go back over this, especially the part about interest rates, the inverse relationship of interest rates and bond prices. And in our next presentation, we will run through the bond types from the least risky. We'll go from the least risky to the riskiest, and then take a look at a few, at least one oddball type of bond, and then we'll look at bond quotes, bond trading, bond ratings, and so stick with us. I know bonds aren't that exciting, but they are reliable. See ya.